Welcome to Jared Invests. And today I'm talking about student loans and everything your school never actually taught you about them before you signed your life away. You signed a legal contract worth tens of thousands of dollars. You were 17 or 18 years old. And nobody in that building, not your counselor, not your financial aid office, not your parents, explained what you actually signed. 92% of student loan borrowers say they would have made completely different decisions if they had understood what they were agreeing to. Let that number sit for a second. You were a teenager handed a document written by lawyers, for lawyers, told to sign it before orientation week ended. No negotiation. No real explanation. Just a number on a screen and a signature box waiting. The system wasn't broken that day. It was working exactly as designed. I'm going to walk you through 10 things about student loans that the system was never built to tell you. Not because they're secret. They're technically disclosed. The fine print exists. But there's a massive difference between information being technically available and someone actually sitting you down and spelling out the real dollar consequences. Nobody did that for you. So let's do it now. $1.84 trillion. That's the total outstanding student loan debt in the United States right now, spread across 42.8 million borrowers. Gen Z borrowers are paying an average of $526 per month, nearly double the national average of $284. You're entering repayment in a harder economic environment, with higher debt loads, and more confusion about the rules than any generation before you. And the rules keep changing. We'll get to that. The first thing they never taught you is how interest actually works while you're still in school. Most people assume their loan balance is frozen during college. It isn't. If you took out unsubsidized federal loans, and most students do, because subsidized loans have strict limits, interest starts accruing the day the money is dispersed, not the day you graduate, not the day repayment starts. Day one. Here's what that looks like in real numbers. A $20,000 unsubsidized loan at the current rate of 6.53% racks up $1,306 in interest every year. Over 4 years of school, that's $5,212 building on your balance while you're sitting in class, working part-time, doing everything right. When your grace period ends and repayment begins, that $5,212 doesn't vanish. It capitalizes, gets added to your principal. Now you owe $25,212. From that point forward, you're paying interest on money you never actually received. That's not a technicality. That's a structural transfer of wealth out of your pocket, baked into the agreement before you ever clicked submit. The second thing nobody explained, the grace period isn't free time. It's a trap. After graduation, you get a 6-month grace period before repayment begins. Sounds like a gift. It isn't. On that same $20,000 unsubsidized loan at 6.53%, roughly $653 in additional interest piles up during those 6 months if you don't make a payment before the grace period ends, and almost nobody does, because nobody tells them to. That $653 capitalizes immediately on day one of repayment. You now owe more than you did at graduation, and you haven't missed a single payment yet. The financially sharp move that almost no financial aid office will ever mention: make interest payments during school and during the grace period, even small ones, even $50 a month. Stopping capitalization early is one of the highest return financial moves you can make as a student. But you had to already know that, and they didn't tell you. Third, you borrowed $10,000, but you only received $9,894. Federal direct loans carry origination fees. Right now, that fee sits at 1.057%. On a $10,000 loan, $105 gets deducted before the money hits your account. You receive $9,894. You owe $10,000. You pay interest on $10,000. Starting day one, multiply that across 4 years of borrowing, and that fee alone costs you hundreds of dollars before a single monthly payment is made. It's not catastrophic on its own, but it's one more layer of true cost that never made it onto the whiteboard in your high school personal finance class, assuming you even had one. Here's where it gets genuinely infuriating. The difference between subsidized and unsubsidized loans is one of the most important distinctions in the entire system. and most borrowers still can't explain it. Both types currently carry the same interest rate, 6.39% for undergrad. Same number. Looks identical. They are not the same product. With a subsidized loan, the federal government covers your interest while you're in school at least half time, during the grace period, and during certain deferment periods. With an unsubsidized loan, that interest is yours. All of it, always. On a $5,500 unsubsidized loan taken out freshman year, you've accumulated $1,430 in interest by the time you walk across that graduation stage. On the same $5,500 subsidized loan, that balance is still $5,500 subsidized loan, that balance is still $5,500 subsidized, so you fill the gap with unsubsidized. And the interest meter starts running immediately. Now let's get to the number that genuinely changes how most people see their debt. Take a $30,000 student loan at 6.5% on a standard 10-year repayment plan. Your monthly payment is $340. Manageable, right? Maybe even less than your car payment. But here's what that payment actually costs you. Over 10 years, you pay $40,855 total. That means $10,855 of your money went straight to interest, 36% more than you originally borrowed. And that's before we account for origination fees, before we account for capitalized interest from school, before we account for a single month in deferment. Run the full math. $30,000 loan. Add the $317 origination fee you never received. Add $5,000 or more in capitalized interest from 4 years of school. Add $653 from grace period capitalization. Add $10,855 in repayment interest. The true sticker price of a loan you thought was $30,000 lands closer to $46,825. That is a $16,825 premium on money you borrowed. And the brochure handed to you during orientation had none of that anywhere. Let's talk about your loan servicer, because this part should make you angry. Your servicer is the company assigned to manage your repayment. They process your payments, answer questions, and in theory help you navigate your options. In practice, servicers have been documented by the Consumer Financial Protection Bureau steering borrowers toward options that were worse for the borrower and better for the servicer's bottom line. Forbearance, instead of income-driven repayment. Consolidation that reset clock eligibility. Misinformation about programs that could have cut payments or triggered forgiveness. The Public Service Loan Forgiveness Program is the clearest case study. PSLF promises forgiveness after 10 years of qualifying payments for borrowers working in public service, government, nonprofits, education, healthcare. One of the most powerful tools in the borrower's arsenal. Instead, 93% of PSLF applications have been denied. Not because most applicants are ineligible, 26.1% of rejections are purely due to incomplete paperwork. Paperwork errors. Not ineligibility. Administrative failures that happen when borrowers get bad guidance from the very servicers they were told to trust. Right now, 2.58 million Americans qualify for PSLF and don't know it. The average forgiveness amount when it does go through, $73,400. That's money sitting unclaimed not because people don't qualify, but because nobody walked them through the certification process. If you work for a government agency, a 501c3 nonprofit, a public school, a public hospital, or certain other qualifying employers, stop what you're doing after this video. Go to studentaid.gov and check your eligibility. Use the PSLF help tool. Don't call your servicer and ask if you qualify. Do it yourself through the official government portal. Now here's a move that sounds smart but can permanently destroy your options. Refinancing. When you refinance federal student loans into a private loan, you typically get a lower interest rate. Feels like a win. On paper, for some borrowers in specific situations, it can be. But here's what gets stripped away the moment you sign that refinancing agreement. Every income-driven repayment plan, gone. PSLF eligibility, gone forever. Economic hardship deferment, gone. Forbearance protections from future federal payment pause programs, gone. You traded a legal safety net for a lower rate. That trade is permanent. Most 22-year-olds refinancing their loans have no idea what they're giving up. They see the rate, they see the lower monthly payment, they sign. And then life happens. A job loss, a health crisis, a career pivot into public service, and they find out those options no longer exist. Not a hypothetical. one of the most common and most financially damaging decisions made by recent graduates. If your loans are federal, treat them like federal loans. Do your homework before you hand them to a private lender. Let's talk about what's happening right now in 2025, because the crisis isn't coming. It's already here. As of April 2025, 25% of federal student loan borrowers are delinquent, 3 times the pre-pandemic rate. 9 million borrowers are now in default. According to data released earlier this year, someone enters default on their student loans roughly every 9 seconds. Every 9 seconds. A missed payment doesn't just affect your loan balance, it craters your credit score. The average borrower drops 60 points when a delinquency gets reported. That kills your ability to rent an apartment, buy a car, qualify for a mortgage, sometimes even land a job. One missed payment triggers consequences that reach far beyond the loan itself. And the policy ground is shifting under everyone's feet. The Save Repayment Plan, the Biden administration's most borrower-friendly income-driven option, was eliminated in July 2025. Gone. Borrowers who enrolled in Save got moved back to other plans, some with significantly higher payments. The strongest income-driven option currently available is IBR, income-based repayment. Under IBR, your payment is capped at 10% of your discretionary income if you're a new borrower, and the remaining balance is forgiven after 20 or 25 years depending on when you borrowed. But here's the piece of new legislation that almost nobody is talking about yet. Starting in 2026, student loan forgiveness is taxable again. If you're on a 20-year IBR track and $40,000 gets forgiven at the end, the IRS treats that as $40,000 in ordinary income in the year it's discharged. In the 22% federal bracket, you owe $8,800 in taxes on money you never received. Add your state income tax on top. Borrowers who've been told their loans will eventually disappear need to understand that disappearance comes with a tax bill. Plan for it now, not when the forgiveness letter arrives. So what do you actually do with all of this? 3 things, concrete ones. First, get your exact loan inventory today. Log into studentaid.gov right now, not the servicer's portal, the federal government's site. You'll see every loan, the type, the rate, the balance, whether it's subsidized or unsubsidized, and who your servicer is. Most borrowers have never done this. They just auto-pay and hope. Knowing exactly what you owe and what type it is, that's the foundation of every smart decision that follows. Second, match your repayment plan to your actual life. If you're in public service, get your PSLF certification form submitted immediately and get on a qualifying IDR plan. IBR is your best option right now with Save gone. If you're in the private sector with a stable income, run the 10-year standard repayment math against IBR and see which costs you less over the life of the loan, accounting for that potential forgiveness tax. Don't pick a plan because it has the lowest monthly payment. Pick it because you've run the full numbers. Third, stop treating your servicer as your primary source of information. Servicers have a documented history of steering borrowers toward worse outcomes. Go directly to studentaid.gov. Use the CFPB student loan resources. Use the PSLF help tool on the official site. If you're carrying $50,000 or more, a one-time session with a fee-only financial advisor who specializes in student loans is one of the best $300 you'll ever spend. Not someone on commission, fee only. Nobody wants to say this out loud, but the system isn't accidentally confusing. Confusing systems get fixed. Decades have passed and the confusion has only grown. You were handed a legally binding contract at 17 or 18, told it was an investment in your future, and given entrance counseling that ran 20 minutes online and was designed to check a compliance box, not actually teach you anything. That's not a failure of individuals. That's a failure of institutions that profited from your signature more than your understanding. But here's what's real. You can't go back and renegotiate the loan you already signed. What you can do is stop operating on incomplete information. The borrowers who come out ahead aren't the ones who borrowed less or earned more. They're the ones who knew the rules of the game. Capitalization dates, servicer limitations, PSLF certification windows, IBR tax implications, details that feel like fine print but are actually the difference between a manageable debt and a decade-long financial anchor. You weren't taught this, that's the truth, but now you know it. Drop a comment below telling me which one of these 10 things hit the hardest, because I want to know what was never explained to you. If this video saved you from making one of these mistakes, Or if you're sitting there realizing you already made one and need a path forward, hit the like button and share it with someone you know who's about to sign their first loan or just graduated and has no idea what's about to happen. Subscribe if you haven't yet, because next week we're going deeper on income-driven repayment, a full side-by-side breakdown of every plan still available in 2025. The exact math on when forgiveness actually saves you money versus when it costs you more, and how to protect yourself from that forgiveness tax bill before it lands. The information was always out there. It just wasn't given to you. That's what this channel is for.